Good afternoon, everyone. This is Chelsea Clark from L&W Insurance, and we are back with Ask an Agent. And luckily, today I was able to scoop up the last actual commercial agent in the agency. Everybody else has already come through, so Brian's in the hot seat now. Do we call it a hot seat? I don't know.
Sure.
Yeah, sure, we'll call it a hot seat. But so Brian is here with us today, and we're going to dive into the concept of coinsurance, and he's going to help break that down because it is a very critical clause that is seen often in business and commercial insurance policies. But understanding it so that you know how that's going to affect your business or your policies at the time of a loss is really important. And we're constantly looking to continue to educate our clients and anybody who's listening to these so that you can make better informed decisions when you're purchasing your insurance and know what are the right questions to ask. So Brian Jones has been with us for 5 years, and he's actually a Sussex County boy, but he does a lot of his insurance up north and actually throughout the entire state of Delaware and beyond. So we are very lucky that Brian came to break this down with us today. So I'm going to go very simple. What is coinsurance?
Coinsurance is basically a clause that you find on insurance policies related to property. That's an agreement between the insurance company and the, say, business owner to basically make sure that the property is insured to value. So the insurance company wants to make sure that they're getting the commensurate premium in return for being able to cover the property in the law in terms of if a claim occurs. What's important to remember here is that insurance policies are written based on replacement costs, not appraised value. So you could have the same exact single-family residence located at the beach versus one that's located in a less desirable area. The one at the beach obviously will appraise for more because of the location, but the replacement cost limit for both of those structures would be the same, even though they're in different locations. Coinsurance is usually expressed on a percentage basis. So the agreement between the insurance company and the insured would be that if you have a $500,000 true replacement cost value for a building, and there was an 80% limit shown on the policy, or coinsurance limit shown on the policy, they would expect that that building would at least be insured for $400,000, which would be 80% of the $500,000.
Okay. So it's really about making sure that the buildings are insured to appropriate value.
Absolutely.
And it keeps, I guess, clients, and this can affect personal insurance as well as commercial, but you see it mostly in commercial and business, but it's making sure that somebody doesn't come in with a $500,000 building and be like, I just want to insure it for $100,000. Right.
Because I want to save a couple bucks this year. Right.
Okay. So then how is this helpful to our clients?
Well, it's helpful because if in the event that there actually was a claim, they would get the full amount of the building. If you're not reaching the coinsurance percentage limit, it could be extremely dangerous.
So is it like a penalty?
It's definitely a penalty, and I can give you an example. So say we talk about a $500,000 true replacement cost limit, and the coinsurance is 80% on that policy. So basically the coinsurance agreement is that building is going to be insured for at least $400,000, which is 80% of the $500,000. So let's say that someone wanted to save a few bucks that year, and I'm only going to insure this building for $300,000.
Okay.
But then there was a claim.
Okay.
Unfortunately.
So
a claim occurs, and they only have a $300,000 limit on the policy. The coinsurance agreement is that they would have $400,000, so they're only at 75% of that limit.
So they haven't lived up to their end of the bargain, essentially.
Exactly.
Okay.
So where it really hits the pocketbook is that in the event of a claim, say there was a $200,000 fire there, they would only get 75%
of what they should be owed.
Of what they should be owed because of the coinsurance penalty, because they weren't insuring it to the 80% of the replacement cost. So,
I mean, that's where it can be dangerous. And not understanding that, it can really hit you during that time because you have to weigh the option of, I may save a few dollars this year because I've carried a lower limit, but if there was a claim, I could really be hit worse because I'm not going to get everything I need to make myself whole in that time of need.
Absolutely.
Okay, so
So
that's
you just lost $50,000 in that example,
okay.
not including the deductible.
But I think that understanding that that's what what coinsurance was designed to do, and to kind of share across between the company and the client that that ability to manage that loss. I think it's important for clients to understand that that's where that penalty could come into play. That it may not always affect you, but when you need it most, it can be detrimental.
Absolutely.
So then, what do business owners need to do to avoid coinsurance penalties? Essentially,
Essentially, you just want to keep on top of it. So it's important to work with an agent that's going to review your policies on at least an annual basis. We all know that the cost of construction goes up incrementally every year. And actually what we saw over the last year and a half was that everything kind of exploded.
Yeah.
So, I mean, you're talking what would have been an appropriate replacement cost limit 2 years ago might not be anywhere near that. It could be 30 or 40% above that. So without doing anything, your limit on your policy 2 years ago would have been fine, but now you would have a coinsurance penalty because the cost of construction is so high. So it's just very important to keep on top of that, review with your agent. Carriers have access to replacement cost estimators that will give you at least a loose idea based on square footage, construction type, location. Agents also have access. I run replacement cost estimators from time to time for my clients, just to make sure we're at least in the ballpark. But I always give my clients the caveat that the only true way to know what your replacement cost is for a particular building, because every building is unique, you need to get a replacement cost appraisal, which is obviously different than an appraisal that you get when you're about to sell your home or buy homes. A true replacement cost appraisal is what will truly tell you the value of the replacement cost.
I'm assuming that's a much more detailed appraisal, but it's going to ensure that you are where you need to be at the time. And to your point, it does change all the time. So
and it's specific to your building, so it gives you peace of mind and you can sleep at night.
That's important. And so obviously anytime we throw these concepts at you, one of the biggest things is that we are the agents that can help you work through that process. If you're unsure of what your building coverage is, or if it is where it needs to be, especially after Brian said the last year and a half, this is the time to reach out to your agents and ask those questions. So having this information and knowing what questions to ask and how to appropriately evaluate all of your buildings and your assets, that's what we're here to help you do. So
absolutely. And raising your building cost or business personal property cost a few, $50,000, $30,000, $20,000 is not going to be anywhere near the expense of losing out if you had a coinsurance penalty.
Yeah, absolutely. All right. Well, thank you. See, we broke that down. That was pretty easy. All right. Well, thank you very much, Brian. And we hope you all have a good afternoon. And remember, you can always send in questions or thoughts or ideas for things you want us to talk about. So we hope you have a good rest of your weekend. Bye.